Hello, Ed Yardeni here. It's February 6th, and hope you all had a good week and weekend. I was in Chattanooga, Tennessee on Wednesday of last week. And then on Thursday, I was in Charleston. Friday morning, I took a flight out in the morning, and I was in the same airspace as the Chinese balloon one day earlier. So I guess I just missed seeing that balloon one day earlier. I don't know if I would have seen it getting blown down, but actually I don't think I would have, because FAA grounded all planes until they shot that balloon down. So here we have Balloon Gate. We'll see how that plays out. It's hard to imagine this is going to have any long-term geopolitical consequences, but let's face it, there is a Cold War going on between the U.S. and China, and it's not getting any better anytime soon. With that, let's turn to what we're most interested in, and that's what's going on in the U.S. economy, the global economy, and financial markets. Let me share my screen with you. Oh, there it is. Oh, that's not the one. Let's try that again. I have too many things on here. There it is. Okay, so lots to talk about. We had an amazing week last week. Debbie and I don't remember a week that was so jam-packed with happy economic indicators. I know this is painful for pessimists to see that the economy might still be growing and that inflation might still be moderating. We also saw last week that Powell kind of toned down his hawkishness. As I wrote, he mentioned the word disinflation 10 times in his press conference. And he mentioned in the context of disinflation has started, mentioned in the context of we're making good progress on disinflation in the goods markets, but he continues to focus on the problems we're having with more persistent inflation in the services area of the economy. He acknowledges that the rental component of services is a lagging indicator and not really very indicative of what's going on with inflation. So he's chosen to focus on core services, energy, core services, excluding housing. And that's still running around 4.5%, 5%. And that's troublesome to him, especially since he believes that a big driver of that particular area of inflation is wage inflation. And he's concerned that that's not coming down fast enough. But I don't think he really spent that much time talking about wage inflation. And the data that has come out, that came out last week, was actually supportive of the notion that wage inflation is moderating as well. So the economy is still flying. It is yet to land, and it's so this debate that I've been having with others between soft landing and hard landing. Right now, it's more like no landing. The economy is still showing some pretty significant areas of resilience and growth. Let's look at this. This is the job market. The payroll employment data came out on Friday, and it was just awesome. So awesome that anyone who was bearish or pessimistic said that those numbers can't possibly be right. And they came up with all sorts of logical, plausible notions with regards to seasonal adjustments and benchmark revisions and all that. That's fine. And maybe they're right that, I mean, it did look as though across the board, those numbers were surprisingly strong to the extent that they might be exaggerated. But on the other hand, we have more labor market indicators besides the payroll numbers that show that the labor market remains very tight and that there's lots of jobs available. So here's the total job openings, which came out early last week. And you can see that that uptick, some people were surprised by that. We weren't particularly surprised because we correlate that with the consumer confidence index, jobs plentiful, and that was ticked up of late. And so we are seeing that the job, but you see job openings are still December, payroll employment's actually January. But you can see we still have something in the order of 2 open jobs for every unemployed worker. This is what I was referring to just now, the jobs plentiful index. That's available through January. And as you can see, that uptick, it is down a lot, but it's still elevated compared to the history of the series. So there's still plenty of job openings. And so consumers are saying that they're seeing them in this data series. And the BLS, the Bureau of Labor Statistics, is saying that their number rose in December. And that's December. This is January. So the outlook is that the job situation, at least in terms of job openings, remains strong in January as well. Now, this is where there's some controversy about, could these numbers possibly be this good? The labor force rose 866,000, which is great. A lot of people coming back into the labor force. And then household employment rose 894,000. So it rose more than the labor force. So the number of unemployed actually declined. And as a result, the unemployment rate fell to 3.4%, which I think is the lowest in over 50 years. So that's good stuff. If you're rooting for a continuation of economic strength, particularly jobs, payroll employment was actually a little disappointing relative to those numbers, but compared to what we've been getting in previous months, as you can see, 517,000 is a very, very strong number. So we'll see what February brings. Maybe February will reverse that. I don't think we're going to get any negative numbers in February, but maybe we'll get less strong numbers in February, confirming that some of the strength in January was benchmark and seasonal adjustment related. But again, the unemployment rate is come down dramatically. It's not as though this is something different from what we've been seeing. It's come down a lot. It's been hovering around 3.5%. Now it's down to 3.4%. And of course, the initial unemployment claims, which came out through the January 28th week, have also been quite low, very low, suggesting that the labor market's doing extremely well. We take the payroll employment data. Debbie and I look at the payroll employment data, and we've come up with a way to immediately focus on what the most important variables are saying. And so we look at average weekly hours, which jumped in January to the upside. And we look at payroll employment, which jumped as well to the upside. And then average hourly earnings, basically wages, rose 0.3%, which is a solid increase, but it's moderating from where it had been. And as you can see in this blue chart, this is what we call the earned income, YRI's earned income proxy. So we calculate that every time the payroll employment data comes out. And as you can see, it was up like 1.5%. Let's say price inflation was up 0.3%, then you still get an awesome increase in real incomes in January. And again, some of that may be statistical issues, but I think that it still is consistent with a record high in earned income proxy. Now, why should we care about the earned income proxy? Well, it's really the way that the Bureau of Economic Analysis calculates the biggest component of personal income, so this is wages and salaries in the private sector in personal income. So it certainly augurs well for a continuation of strength in purchasing power. So as you know, people like Jamie Dimon have been saying that consumer spending is running on fumes, I should say. The fumes that it's running on is the excess savings that were accumulated over the pandemic situation, with people saving money during the lockdowns, and then with people getting all these checks from the government. And so by some calculations, there's still $1 trillion to $1.5 trillion in excess savings, and that's what consumers have been spending. I think there's something to that, as I'll show you in 1 second, but that's not the whole story. I think the employment gains are an important source purchasing power for anybody who had no income before they got a job. And then I think we're starting to see wages rise faster than prices. Let's put it this way. I think we've got disinflation in wages and prices. I just think prices are disinflating faster than wages, which then leaves you with real increases in inflation-adjusted wages. That clearly drives things like retail sales and personal consumption expenditures. Retail sales, of course, is spending on goods. Personal consumption expenditures are spending on goods and services. This is what I wanted to bring to your attention here. This is disposable personal income. So it's the wages and salaries we just looked at with all kinds of other components of personal income. And then you take out taxes and you've got disposable personal income. So that's what we're seeing in the blue line in nominal dollars. And you can see that disposable personal income got charged up with these rounds of checks sent to people, helicopter money, basically. Now, if we adjust this for inflation, so just divide the blue series by the consumption deflator, including food and energy, the whole thing, what you see is you see the same kind of pattern here, but you also see that inflation really cut into the purchasing power of disposable personal income. So I would say it's a reasonable argument to say that excess savings offset the drop in disposable personal income back here. And now, if they run out of that excess savings, I think we're going to be watching the more traditional driver, the more traditional fuel of behind consumption, and that's disposable inflation-adjusted real income. And as you can see, that's starting to move up. And that's what it does during economic expansions. If you think a recession's coming, then it's going to move down. If you agree with me that employment is going to continue to increase at a more moderate pace, that wages will rise faster than prices, then that will be an important source of purchasing power to keep the economy growing, at least from the consumer standpoint. Now, while we've been focusing on this pivot by consumers from goods to services, meanwhile, one of the item in goods has actually decided to jump to the upside here. So U.S. motor vehicle sales, you can see, took a big jump in January. That's going to have a positive impact on GDP calculations. And it does suggest, as you can see, that there probably were a lot of not just pent-up demand, but a lot of pent-up orders, particularly for light trucks. And maybe Detroit's finally been able to find the parts for the trucks, and as a result, we've had this big jump in car sales. Now, again, car sales has really this statistic is independent of the payroll employment data, but it certainly tends to confirm that things were getting hotter in January, which is kind of perverse because I thought the blizzards and the horrible weather in California would keep people from buying cars and so on, but and maybe employers from hiring people, but the data suggests that that's just not the case. Let's look at the employment data a little bit more closely and see what that's telling us. And what that's telling us is that the auto industry is, in fact, strong. We're seeing that manufacturing payrolls rose to 1 million, so it's the higher than the pandemic. It shows that retail payrolls in the auto industry, so it's all the dealerships and so on, that's continuing to move higher, has yet to rise above that, but it probably will. Now, another one to the upside, which is an independently sourced series, is the NMPMI, the non-manufacturing PMI. By the way, you should just know that it includes construction, so construction may have some impact on the NMPMI, but it's basically viewed as services, the services industry, and I think it's reasonable to look at it that way. And there's a lot of moving parts here in the components, but the basic point is it shot up to 55.2. The new orders are 60.4. That makes more sense than this, I think, aberration. Any data that doesn't support my story is aberrant and is going to be revised to show I was right after all. That's my attitude about these things. But it did bounce right back up, consistent with, I think, what we're all seeing at the airports and at the restaurants and hotels and motels. Everything is packed. So the service economy is still an area of strength. The MPMI continued to drop below 50 for, I think, 2 months in a row here, 47.4. But again, that's has to do with this pivot away from goods to services. In the past, seeing it drop like this could raise the alarm about a possible recession. But you can also see that there have been these mid-cycle slowdowns here and back here that were not, in fact, signaling a recession, but just a slowdown. Let's look at employment again. And this is payroll employment for all industries that were most at risk of pandemic layoffs. And so you can look at the footnote on your own, but you can see that they took a huge dive here during the pandemic. They've been recovering ever since, and we still haven't fully recovered, but we're still seeing expansion through December. There's some series that are only available through December. You take them out, you get a smaller series, but it's still rising in January. So again, when you drill down to the employment numbers, they look pretty good, and I have a few more to show you. But before that, we also got mortgage applications last week. We'd get that every single week on Wednesday, and look at this. This is up, but certainly starting to look like a bottom here in demand for housing. Prices have come down, mortgage rates have come down. Maybe that's just a temporary situation if mortgage rates go back up, but prices are falling, making them more affordable. They rose dramatically in the past 2 years, so some people who really want to sell, easy come, easy go. They made, on paper, a lot of money over the past couple of years, and now they have to give some of it, maybe a lot of it back in order to get their house sold. Another little uptick here is in the pending home sales and housing market indexes. Pending is for existing home sales, and housing market is for new home sales. So we're seeing upticks here in January and in December, and these two indicators consistent with what we're seeing. So maybe housing has hit bottom, and the housing stocks certainly have been on fire. So how about value of construction put in place? That was another indicator that came out, and it doesn't look that bad. Now, some of it may be inflation, clearly, so you got to factor that in, but it's basically in nominal terms, all-time record high. You're not seeing this kind of recessionary situation just yet. When you slice it and dice it into residential, non-residential, and public, you can see that the residential has been coming down, and all of that really is single-family housing. Multifamily has offset some of that weakness. But meanwhile, look at non-residential construction spending. Manufacturing plants are going up. Communication facilities are going up. There's a lot of structures that are being built, and this is at a record high. Again, some of it may be pricing, but it's certainly going in the right direction. And public is kind of going up a little bit sideways here. But I think there's every reason to expect that public construction is going to be a big contributor to construction growth in coming months because of all the infrastructure spending, chips plants, semiconductor plants spending. And so that will be a source of strength. And maybe this bottoms and maybe this keeps going up. So where's the recession and all that? Payroll employment in construction, all-time record high in January. So if single family is in recession and everything else is doing okay, that's consistent with construction workers finding jobs and having plenty of jobs to go for if they want to. Just for fun, this goes all the way back to 1939 and with a ratio scale, so you can stare at it on your own. But construction recessions tend to be coincident with economic recessions. They go down when the economy goes down, but that hasn't even been the case so far in the employment numbers. Manufacturing employment, we can take payroll employment in manufacturing and multiply it by the aggregate weekly hours, average weekly hours, and get this aggregate weekly hours. So it's an index of the total hours that are being spent in producing cars. And you can see that it ticked down for a couple of months at the end of last year, then it ticked up, whereas the actual industrial production of manufacturing, I'm sorry, I didn't mean cars, I meant total manufacturing production declined here, then it upticked. And this manufacturing industrial production declined 2 months in a row, but the latest data suggests that maybe it'll uptick. So it's not going straight down. It's not a hard landing, and it's more of a soft landing situation so far. Here's another one. This actually, the trucking transportation tends to be very highly correlated, tends to track the leading economic indicator. LEI has 10 components to it. Here's one simple indicator that's got a pretty good truck record, I should say, of telling us what the economy is doing. And again, it gives you sort of a lead here. It's slowed down before this recession. It peaked and came down before this recession. It tends to peak well after recessions, so it's not going to tell you the recession's over. But here again, it peaked actually before the COVID recession, and who knew that was coming? And here, January, it's at an all-time record high. What do truckers move? They move goods. So it's a service part of the economy that moves goods. And for all the concerns about the pivot from goods to services, goods are being moved. And again, this is employment data, so it's real. It's people. It's not. We don't have to adjust it for inflation. Let's talk about inflation. In the morning briefing, I did a piece on Powell's press conference. Counted that he mentioned the word disinflation 10 times, all by himself. No reporter used that word. Then, if you compare that to the press conference before that, the previous press conference, the word disinflation was mentioned twice by reporters, not by Powell. That's what the markets got all excited about, is that he actually acknowledged that we are making progress on the inflation front. But he offset that by saying that's not good enough and we're still going to be raising rates. But he basically said, he did say that there's 2 more rate hikes coming of 25 basis points, and that might get the Fed funds rate into where they want it to be in terms of restrictive level, and then they're just going to keep it there. And the economy has demonstrated that it's resilient enough to handle that. Kind of the idea of going back to the old normal, where the economy can grow with inflation 3 to 4%, interest rates 3 to 4%, and I think that's kind of where we're heading. So let's look at some of the relatively happy inflation indicators we got last week. You can see this is headline CPI. That came out a few weeks ago, but look, it's pretty highly correlated with what drives inflation, and that's unit labor costs. It's the bulk of the cost of production, certainly for goods and services, obviously. And so there is a fairly good correlation between the two. And so unit labor costs came out with productivity and compensation on last week. I think it was Thursday. And you can see that it's down to 4.5%, clearly moderating from looks like about 6.5%, thereabouts. The average hourly earnings is the monthly data series that comes out with payroll employment, with the employment series the first Friday of every month. And you can see that for all private industries, it's moderated to 4.4%. The Fed, I think, would like to see it get down to 3%, 3.5%, and I think that's probably where it's heading. By the way, production and non-supervisory workers account for about 80% of the labor force, so that would be presumably lower wage workers relative to the higher wage workers that are included in total private industry. And lower wage workers have been seeing higher wage increases than people paid at the top of the income scale, and that's a good thing, because there's a lot more of them, and they are getting real purchasing power increases, and that helps to fuel the economy. Finally, we've got the ISM prices paid indexes, and you have a look at it on your own. It's not terribly compelling in terms of correlation, but it seems to be telling my story. So let's tell it. And you see that the ISM prices paid index in manufacturing 3 months ahead looks like, at least recently more than in the past, is a decent indicator of where goods inflation is going. And so it's come down sharply here, and it suggests the goods inflation is likely to come down. The goods inflation is durable goods and food and non-durable goods, food and energy. And that's down to 4.6%. We know that durable goods has actually turned negative on a year-over-year basis. It's gone down from 18% last summer down to minus 1.0% for durable goods. And I think it stays in negative territory because that's what it's done in the past. And then we've got the ISM prices paid index in non-manufacturing. This time you have to push it ahead 12 months. And 12 months ahead, it suggests that it's may very well be peaking now. This is the ISM index pushed ahead. And this is the services PCD inflation rate, which is 5.2%. So hope that that was useful. And now let's get to some discussion here, which I hope will also be useful. So Dan asks, the 2023 consensus estimate seems to be falling fast. How does the trajectory of this decline compare to prior years over comparable time periods? Not sure which consensus you're talking about, but I have a hunch that you're talking about 2023 earnings, and 2023 earnings are falling for sure, as are 2024. But 2024 is still $250 a share. And when we look at the relevance of earnings to the stock market, we look at a time-weighted average of this year and next year. So every single day that time passes this year, we're giving less weight to this year and more weight to next year. And I think that's the best way to understand how it's possible for the market to go up when analysts are cutting back their earnings expectations. Even during good times, analysts tend to be too optimistic and have to lower their current year and coming year expectations. So that's not unusual during good times, and it's certainly not unusual during bad times. Like these are, I guess you could characterize them as questionable times. So that's a debatable times. I don't think they're all that bad, and I think that we are likely to see that the 2024 earnings remain at a level that allows the market to continue to move higher over the rest of the year, not in a straight line path. As we've been pointing out recently, it's there's a lot of technical indicators. I'm not a technician, but we got Joe Feshbach, who kind of helps us a lot in that area. Joe Abbott looks at the technicals quite a bit. And it's a fun game to play. So let's see. Michael Costin at Goldman says the good economic news is priced in. Agree, disagree? I think in the short run, the good news is priced in. And I think we still have this problem that good news is viewed as possibly bad news. Maybe that's one of the reasons the market, let me see what it's doing now. Yeah, it's down a bit, not a lot. I think the good news is the economy's hanging in there pretty nicely, as we just said. And I think earnings are getting squeezed somewhat by profit margins. But I think the 2024 number is going to be higher than the 2023 number. And I think that's going to be higher than the 2021 number. So I think I'm not in the hard landing camp, just sort of mid-cycle slowdown. I think the market could just kind of move sideways here for a while, maybe retest to 4,000. There I go again, pretending I'm a technician. But all in all, I think this is not 2022 all over again. The Fed is just about done raising rates. Then we all know that they intend to keep rates at 5.25% for the rest of the year. And so far, we seem to know that the economy can handle it. And so far, we seem to know that inflation's moderating. So who's really got a problem with that? Okay. Anonymous, think we are surely headed for a freight recession. Retailers appear wary of a consumer rollover and are focusing on selling what they have. Little to no peak season observed in the fourth quarter. Blue chip truckers missing earnings already. Management taking numbers down. Now, that said, this is such an early cycle industry that bad news is good news is in full effect and stocks are rallying. Yeah, we really do like to keep track of the truckers as an economic indicator, and particularly like the employment numbers, particularly like them now, because they support our notion that it's a soft landing. It doesn't even support that; it's supporting no landing. So I mean, if truckers are that cautious, why are they hiring? Again, maybe it's the seasonal adjustment factors that are messing things up. I don't know. But we also look at the ATA freight truck index, and that's kind of gone sideways with some volatility, but near all-time highs. We look at purchases of mid and heavy trucks, and they're holding up pretty well. And then anecdotally, you got some anecdotes saying that truckers are cutting back and are worried, and the retailers are doing the same. And I saw some story about one truck company that was predicting that things will be better by the second half of the year. And again, the market looks ahead. But thanks for that. Alistair, is the greater risk for the market now that we don't get a recession? The labor market remains tight and wage price inflation takes off again, causing the Fed to have to raise further after the pause. What probability would you put on that scenario? I mean, it's a reasonable concern that, well, we've all been debating soft landing or hard landing. Turns out that the economy has no landing, and by that I mean it grows 2.5% to 3%. I got 1% growth in the first half of the year, 2% growth in the second half of the year. So that's a soft landing. It's a kind of a growth recession for at least half a year. But it's conceivable. I mean, I don't know. I haven't thought about it that much. So I have been thinking about the no landing as really being consistent with the soft landing in terms of its financial implications. But if we have a no landing scenario where inflation doesn't moderate and the Fed has to go much higher, then I guess at this point I'd give it 10-15%. But I'm speaking off the cuff. I'll try to address it better in writing in the next few days. Okay, Doug, where do you stand on the stay home versus go global? I've been writing that I think for the next 6 months, go global is fine. The dollar is weakening. I think what changed is the perception that Europe is going into recession. Well, now it's not going into recession. I think there was a perception that China was going to go into zero COVID recession, and that's not the case anymore. So it's kind of funny that the consensus is willing to change pretty rapidly from a pessimistic outlook to a more optimistic outlook on Europe and China, yet there's a lot of debate about the United States, where there's still a lot of people saying one way or the other this bear market isn't over and a recession is coming, and that's not where I'm at, as you know. So I would say Go Global offers some better valuation deals, but a lot of them have been picked pretty rapidly here. It's not as though we just discovered this. Europe and China's have had some significant rallies in their stock markets. I have no problem at all going global with the U.S. companies that are still relatively inexpensive and go global for you. So there's some thoughts. I think we're going to have to call that it. Let me just see. One more question from Jack. If you were a voting member of the FOMC, what would you do this year? If I was a voting member, I'd do what the Fed said they would do back in December, 5.25%, and leave it there. Economy seems to be able to handle it. That's what I would do. Well, thanks very much, everybody. Have a good week, and we'll do this again next week. All the best to all of you.